If your salary has gone up in the last few years, but you don't feel any better off, really, you're probably not imagining it. You might be earning a few £1,000 more than you were in 2021, say, and yet when you look at your take-home pay, something doesn't add up. You're working harder, you're earning more, but still feeling a bit squeezed. And it's not just inflation, it's not just the cost of living. There is an additional tax that gets quietly applied to millions of UK workers, and it hides inside something called fiscal drag. Horrible financial term, but by the time most people realise that this is happening to them, they've already handed over thousands of pounds in tax that really they didn't have to. So today I want to show you exactly what's going on, how it's all calculated, and more importantly, 3 practical things you can do right now to claw back as much of that money as possible. Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK. And on this channel we cover everything you need to know and everything you need to do to build a solid financial future. And this particular video is brought to you by Meaningful Academy Build Wealth. More on that towards the end of the video. Right, let's start with the basics because understanding why this is happening is the first step to doing something about it. So income tax in the UK works in bands, and I'm going to scooch a little bit here to leave a little bit more space here on this side of the screen. So you've got your personal allowance. That's the amount you can earn before paying any income tax at all, and that's currently sitting at £12,570. Above that, you pay 20% basic rate up to £50,270. Then 40% higher rate income tax above that, all the way up to £125,140, and then 45% above that. Now, you might expect that those thresholds would rise every year, maybe broadly in line with inflation, because if wages go up and prices go up, then the thresholds should go up with them, surely, so that your effective tax burden stays roughly the same. Yeah, you would think that, wouldn't you? But in the 2021 spring budget, the Chancellor froze all of those thresholds, not for just a year or two, but originally from 2021 to 2026. And that freeze has since been extended twice more, first to 2028, now to 2031 for income tax. Now, here's why that matters. Wages in the UK have risen meaningfully since 2021. Sometimes actually by 5, 6, 7% in a single year. It obviously differs whether you're in the public or the private sector or what. But when wages rise, but tax thresholds don't, 2 things happen. First, the amount of your income that is taxable gets bigger. A bigger slice of what you earn falls above that frozen personal allowance. And second, more and more people get dragged into higher tax bands. So someone who was comfortably a basic rate taxpayer in 2021 might now find that a portion of their income sitting above the 5270 limit is being taxed at 40%. Nobody changed the rate. It's just that the goalposts didn't move, and that is fiscal drag. That is stealth tax. And the scale of it is significant. According to the Office for Budget Responsibility's own analysis, the combined freeze of income tax thresholds is estimated to raise £42.9 billion for the Exchequer by 2027-28. That's relative to what would have been collected if the thresholds had simply risen with inflation. And the OBR also estimates that by 2030-31, the proportion of taxpayers paying higher or additional rate tax will have risen from 15% to 24%. That's nearly 1 in 4 of us paying higher rate income tax. Obviously that money's got to come from somewhere, and it's coming from payslips. Your payslip, mine. So let me put some examples on this, right? Because fastest way to lose people is to just talk in the abstract about tax. So we're going to run through what this actually looks like at 3 income levels and show the working. Now, I sometimes get some grief for using high income levels and high investment levels in my videos. I don't really care because it's examples, that's all. Essentially, this affects everybody if you've got earnings above the personal allowance. But here's example 1. This is Sarah. She's earning £52,000 in the 25-26 tax year, so the one that's just ended for the purposes of this. So under current frozen thresholds, this is Sarah's income tax calculation. The personal allowance is £12,570, so her taxable income is her 52 grand salary minus that £12,570 figure, which leaves £39,430 taxable. The first $37,700 of that sits in the basic rate band and is taxed at 20%, which gives tax of $7,540. The remaining £1,730 of her income sits above the higher rate threshold, and that is taxed at 40%, giving rise to £692 of tax. So her total income tax bill is £8,232. Now, let's ask, what would Sarah have paid if thresholds had simply risen with inflation since 2021? Well, the OBR estimates that the personal allowance would be about $4,900 higher by the end of the freeze period, that's 2031, and the higher rate threshold around £20,100 higher. So given that we're not in 2031 yet, we're going to apply a sort of proportional midpoint adjustment, and we're going to make the personal allowance $13,900 and the higher rate threshold of around about $56,000. And using those figures, Sarah's picture changes quite considerably. Her taxable income, less the larger personal allowance, is now $38,100, and all of that falls below the higher rate threshold, so it's all taxed at 20%, giving total income tax of £7,620. Difference? That's roughly £612 a year, every year, and that's just from the freeze alone. And of course that compounds. Over 5 years, we're talking £3,000 or more. Not enormous, you might think, but that's money in your pocket, not the revenues. And that's without anybody having to announce an income tax rate rise. It just happens. Okay, here's a second example. This is Baha. It's the name of somebody I met this week, so I thought I would use it. And Baha is earning £80,000, so he's well into the higher rate band. And arguably the impact here is more pronounced. So under the current frozen thresholds, his taxable income is $80,000 minus the personal allowance. So that leaves £67,430 taxable. Basic rate on the first $37,700, higher rate on the rest, gives total tax of £19,432. Under the hypothetical indexed thresholds, these are the numbers, with total tax saved every year of £1,412 every year. And Baha has something else to think about, child benefit. If one partner in a couple with kids is earning between £60,000 and £80,000, the high income child benefit charge starts eroding that benefit pound by pound. And by £80,000 a year, it's gone completely. So fiscal drag has dragged more people into that zone as well. Okay, let's look at a really high earner. This is Claire. She's earning $110,000 a year, and to be honest, this is where things get genuinely painful. I think here taking action is the most urgent. Because above $100,000 a year, the personal allowance starts being withdrawn at a rate of £1 for every £2 of income above that threshold. And by a salary level of £125,140 a year, the personal allowance is gone entirely. So for income between $100,000 and $125,140, you're losing £1 of tax-free allowance for every £2 that you earn. And that means an effective marginal tax rate of 60% on that slice of income. 60 pence in every pound going to the revenue. That is unpleasant by any measure. So if Claire earns $110,000 a year, she only has a personal allowance of $7,570, not $12,570, and that means $102,430 of her income is taxable, and that gives rise to a total income tax of £33,432. Now, if Claire can reduce her taxable income, for example, spoiler alert, by making pension contributions, well, that can bring her adjusted net income back down below the $100,000, and she recovers the full personal allowance. Now, before we get into more detail about what to do about all of this, if this is useful so far, then do hit the like button and subscribe to the channel if you're not already. Over half of you watching this are not subscribed, so help me out and make sure that you see the next video. Hit the subscribe button now. Thank you so much. Okay, look, let's look at 3 levers that you can pull to improve things in the face of this insidious fiscal drag. Number 1 is pension contributions, and specifically, first of all, salary sacrifice. Honestly, this is the single most powerful lever for the majority of people, and it works really because of fiscal drag. So here's how salary sacrifice works in practice. You agree with your employer to take a lower gross salary, say £1,000 a month less, in exchange for your employer paying that same £1,000 directly into your pension. Because you are paid less, your tax and national insurance drops too, but your £1,000 still goes to you. It's just now going straight into your pension. So let's put some numbers on that. Say you are Baha from earlier, earning £80,000. Well, if you salary sacrifice 10 grand a year into your pension, your gross income for tax purposes falls from 80 down to 70. You have moved £10,000 of earnings out of the 40% tax band. So your income tax saving is £4,000. Plus, you save employee national insurance at 2% on that. That's another £200. Total saving then from the salary sacrifice is £4,200. Money that goes into your pension rather than to the government. For someone like Claire, who's on 110 grand a year, salary sacrificing enough to bring her adjusted net income down to 100,000 recovers the full personal allowance. And the effective tax saving on that manoeuvre is about 5 grand. So a salary sacrifice of £10,000 saves her roughly £5,000 in tax. 50% instant return before the pension even grows. Now, if your employer doesn't offer salary sacrifice, you can still contribute to a personal pension or to a SIP and claim higher rate relief through your self-assessment tax return. The maths is essentially the same, it's just a little bit more convoluted. Okay, the second lever is the use of ISAs. It's simpler, this one, but it is meaningful over time. Your ISA allowance is £20,000 every year, and every penny that's saved or invested inside an ISA grows completely free of income tax, dividend tax, capital gains tax, nothing to declare, nothing to pay at all. So in a higher tax environment, the ISA wrapper becomes more valuable just because the world around it has got more financially harsh. So if you've got savings or investments sitting outside a tax wrapper, maybe in a general investment account, a GIA, savings account attracting interest above the personal savings allowance, or maybe shares generating dividends, I think it's worth reviewing whether more of that money could be inside an ISA each year. Now, it won't reduce your current income tax bill the way pension contributions do, but it does progressively shelter your growing wealth from an increasingly unforgiving tax environment. And lever number 3 is, well, I'm going to call it income planning, right? Especially this is the case if you're above £80,000 of salary. Child benefit. Remember, that high income child benefit charge kicks in at about 60 grand a year, and it removes the benefit entirely by £80,000. But income, for this purposes, is actually your adjusted net income, and that includes pension contributions as a deduction. So if pension contributions can bring your adjusted net income down below 60 grand, you can reclaim child benefit that would otherwise be lost. And for a family with 2 or 3 children, that can be worth over 3 grand a year, and that's on top of the direct tax saving. Don't forget gift aid. If you make charitable donations, gift aid them. As a higher rate taxpayer, you can claim back the additional 20% relief through self-assessment. It reduces your tax bill, and it's entirely legitimate. And think about timing. If you have any element of control over when your income arrives, so maybe a bonus that you can defer, dividends that you can manage if you're a company owner, or maybe property income, being deliberate about which tax year that income falls into can reduce the rate at which it's taxed. Definitely worth a proper conversation with a financial planner or your accountant if the sums are significant. And by the way, if you know somebody who's had a pay rise recently and is wondering why they don't feel better off, maybe share this video with them. It might save them a meaningful amount of money. And if you're at the point where you want a structured way to think about all of these levers together, pension, ISA, and income planning, all working in concert together, that is exactly the kind of thing that we cover inside Meaningful Academy. So whether it's the Financial Foundations course, which is free, or the Build Wealth course, both of these are built to help you understand all your options and help you put a sensible plan together for yourself. The link is in the description if you want to take a look, and if you decide that it's for you, use the coupon code YouTube for a discount. Okay, let's bring all this together. Stealth tax, this fiscal drag, it is real, it's ongoing, and it's costing many UK workers much more than they realise. And it's not because income tax rates went up. Remember, the government promised not to do that. But it's because the thresholds didn't move and wages did. Remember the 3 levers. First, pension contributions, especially salary sacrifice. Reduce your taxable income by paying into pensions. The saving at higher rates is substantial, and above 100 grand salary, honestly, the difference is extraordinary. Then use ISAs to shelter your savings and investments from a harsher tax environment and build a long-term firewall, if you like, around your growing wealth. And then third, income planning. Be deliberate about child benefit, gift aid, the timing of variable income, especially above 60 grand a year. Honestly, none of this is complicated, but it does require knowing that the levers exist and then actually pulling them, using them for your own benefit. And now, once you understand why you should be using your pension and ISA to fight back against fiscal drag, the very next question most people ask is, well, when should I use which one? Which one comes first? And how much should go into each? Well, that's exactly what this video covers, pension versus ISAs. So many people get it wrong. And if you found today's video useful, you'll find that that one is genuinely valuable as the next step. So go watch it now. Thank you so much for being here. And if this has helped, give us a like, subscribe to the channel if you're not already. It all goes a really long way. Thanks so much. I'll see you in the next one.